Okay, so today's class is devoted to assignment 6. And assignment 6 itself is based on case number 7 from your textbook. So what we will do today, we'll go over the case and we'll talk about some of the mechanics or some of the technicalities for creating the decision support system that is outlined in that case. Okay? And also I would like to give you I guess a word of caution and encouragement. This case may seem to be quite complicated. Okay? Now, the reason it's complicated, it may be complicated for those who are not pure business majors because it talks a lot about the banking industry, the finance industry, accounting, finance, investments, and all those things. Okay? Actually, I thought about it for a while. I was thinking, well, should I give this case to you or not? Because some of you guys, you didn't take too many courses in accounting or finance. And then I decided I will go ahead and give this case to you because it will give you at least some exposure to the banking/finance industry. Okay? I think I told you last time that this can be a very lucrative domain for your career because I don't think you can be like a pure IT person. I mean, most likely you'll specialize in some kind of industry, right? So one of the industry that you can specialize in is banking and finance. If you have, no, I wouldn't say talent, but if you have the kind of mindset or personality for it, because not all people have the personality to deal with numbers. Like some people feel bored, when it comes to doing accounting work. But some people like it, and they're very good at it. So this is something for you to consider. So that's why, I decided to keep that case because it gives you some exposure to the banking industry. And speaking about banking industry, I think I told you also last time that we had a visitor, an HR manager from CSI, which is, stands for Computer Services Incorporated. It's that company headquartered in Paducah. And they told us that they hire a lot of our TSM and CIS majors. And one of the main reasons they hire them is that, in addition to having technical skills, they also understand the business side of their the business aspect of their business. And as you probably know, CSI serves banks, right? So a lot of the networking services that they provide are somehow related to those banking services. Again, if you work in telecom, if you're a TSM major, of course you're not going to be dealing with transactions directly. But I think it's a very good idea for you to at least understand what those transactions are all about that you're trying to support with your networking services, right? So that's why I'm keeping this case. Okay, with that being said, let's talk a little bit about the background of the case. Okay, friends, so it looks like everybody who intended to read the background section is already done, and people who didn't intend, there's no point of waiting because they're checking Facebook or something. Well, anyways, let's continue with this case. Now, before we go into the case itself, there are some background details that I would like to share with you. First of all, this case is entirely about doing something called stress testing. Have you heard this idea before? There's one thinker, whose philosophy, whose work kind of spans several areas. First of all, it's probability theory, mathematics, finance, but also some social phenomena explored by his writings. His name is Nassim Taleb, and in my opinion, he's one of the most influential philosophers of of our times, especially when it comes to probability theory, right? Practical applications of probability theory. And he wrote a number of books, and they're saying, look, one of his 3 books, which is Black Swan, it was voted to be one of the most influential books since World War II. Something that I agree, although if you want to read his books, I suggest you don't start with Black Swan, which is book number 2. There's the first book that he wrote in the series. It's called Fooled by Randomness, right? And one of the key messages of that book is that humans are very bad when it comes to understanding probability, right? And also humans have this illusion of control of the future. Now, somehow they think that they can predict future, that they can understand what will happen in the future, okay? And then, a black swan, and by black swan he means unexpected event, comes in and it kind of changes our plans and everything, reshuffles everything around, okay? So, I mean, he has a lot of things to say, but his key message is that we cannot predict future. We cannot predict future with high degree of certainty, therefore we shouldn't do that, okay? Because it's very dangerous to assume that certain events will or will not happen in the future, okay? So what do you do instead? Well, instead, he said, you can do something similar to Monte Carlo experiment. Monte Carlo experiment means you don't try to predict the future, right? But you're trying to enumerate or list various scenarios that can happen in the future, right? Because you don't know what exactly will happen, but you're trying to think about various possibilities, right? And then given those various possibilities, you're asking yourself, am I prepared for those different possibilities or not? Of course, some of those possibilities may or may not happen, but you're just asking, in theory, do I feel prepared, given that a number of things can happen in the future? Okay, so that's the essence of Monte Carlo experimentation, and that's the essence of stress testing. Okay, what happens? By the way, it's not like some kind of silly intellectual exercise that we are doing. It is done on a regular basis. Of course, it's not done like using simple models like the one we're going to create. I mean, I'm sure those models are very sophisticated. But stress testing is done routinely by leaders in different countries. Okay. Now let me give you like possible scenarios. A possible scenario, hypothetical scenario. Let's say we're talking about Bank of America. By the way, I didn't realize how big Bank of America has become. Now look, they have 2.15 trillion in assets under their management. In other words, they control loans and deposits amounting to $2 trillion, right? Now, what is the overall GDP of the United States? Yeah, it's like, I just looked up, it's like 17 trillion, right? Now, think about it. One single bank, right, controls how much? More than, like around 12% of the US economy. Can you imagine that? Just one organization controls 12% of the economy. Not cash reserves, right? Not 12% of the banking of the entire country's economy, right? Now, what do you think will happen if this bank collapses? I mean, if it goes bankrupt?
It was too big to fail, if I remember correctly.
Yeah, I mean, this bank is basically too big to fail, which means that nobody can afford failure of a bank like Bank of America, right? Now, imagine the following scenario. Something illegal is happening at this bank. Let's say some kind of insider trading or some kind of illegal manipulations with tax reporting or something like that. And then let's say President Obama, he has this tough choice. I mean, according to the law, he needs to take some action against them, right? I mean, he needs to fine them. He needs to declare this bank bankrupt, all those things, right? If, let's say, their finances are going down and there's some level of illegal activities going on, right? So according to the law, basically, they need to prosecute this bank, okay? Now, he may also be very reluctant to do that because, if this bank goes bankrupt again, it's just too big to fail. It will have those ripple effect, right? It can take the entire global economy down, basically. Not just U.S., right? Not just in the United States, but the entire global economy can go down if one bank like Bank of America fails, right? So in that case, and by the way, remember the recent financial crisis that started in 2008? Do you remember what was the first event in that crisis, like the thing that really got everything started? Do you remember what happened first? Well, yeah, it was related to mortgages, but mortgages were kind of building over a long period. Now, the first event was bankruptcy of Lehman Brothers. Now, Lehman Brothers was a huge financial services company. I mean, I think you can call it like investment bank, right? So Lehman Brothers, they were losing money, and they were losing money due to those bad mortgage instruments, right? And eventually they went bankrupt, and this is how this whole global crisis has started. Because Lehman Brothers took, with them, a number of other banks. Like the second bank that went bankrupt, from what I remember, was Bear and Stearns, right? Or Bear and Stern. That was the fifth largest investment bank, I believe, or sixth largest investment bank that also went bankrupt after that. And then one bankruptcy after another, we had this global financial crisis. Okay, so some banks are just so big we cannot afford. I mean, if they fail, then they create like that large ripple effect, right? And speaking about that, you probably heard like about this issue of globalization, right? And maybe you have wondered, like whenever they have this World Economic Forum in Davos in Switzerland, there are always those violent protesters attacking those participants, right? Now, why some people are against globalization? Well, some people, they just like take that narrow view, like, they're saying, well, globalization is killing our lifestyle. Like, for example, they're saying, well, I'm from a small town, we had all those little shops, and then Walmart came in and they put everybody out of business, so now Walmart controls our town, not those family businesses, right? So that's that narrow perspective. Now, some people take, like Nassim Taleb, they take more like macro perspective. What they're saying due to globalization, there's an increasing level of interconnectedness, meaning each bank, like Bank of America, does business across the globe with various other banks, governments, institutions, right? Everything is just so interconnected that it becomes too complex for anybody to understand what will be like a side effect of a bankruptcy, let's say, right? In fact, Nassim Taleb, he says, we were better off in the old days, like before 20th century, right? And the reason we were better off because people were living in those small communities, and if something happens in one community, it doesn't impact all communities globally, right? Nowadays, things are becoming so complex that if something happens in Asia, in China, in South Korea, in the United States, it will impact the entire world, right? Speaking about that, even before that, remember, before 2008, there was another crisis. It was called Asian financial crisis in 1998, right? And again, this whole global crisis was triggered by two events. The first event was Asian countries, their economy started, I forgot what exactly, it was like something related to agriculture trading, but nevertheless, they took like some kind of loss. Like a lot of Asian countries, they took loss on some kind of agriculture dealings or something like that, right? The other thing that happened is that Russia was heavily invested into some of those Asian companies, right? Next thing that happens is that some U.S. Hedge funds, they were heavily invested in Russian government bonds, right? So Asian crisis triggered default of Russian government in 1997 or 1998, and then because some U.S. Hedge funds were heavily invested into that, they also went down. And then those three things led to the entire collapse of the entire global economic system, right? And that also reminds me of that fund, Long-Term Capital Management. It was managed by two Nobel Prize-winning economists. One of them was Martin Scholes, right? So he received Nobel Prize in economics, and he managed that fund for 3 years. For 3 years, they achieved spectacular returns, like 30-40% per year. On year 4, which was 1998, they lost everything. Everything that they owned, and everything that they had under their management was lost, right? And that's when the government had to step in and kind of basically buy them out, because they were afraid that it will lead to a huge collapse of the entire banking system in the United States, right? So whenever something like that is boiling, let's say Bank of America is up to something, and some tough choices need to be made, it's typically done at the president level. Like Barack Obama, he would call his financial advisories, maybe Warren Buffett, and get them all together, and they will do stress testing. They would ask, okay, let's think about possibilities. If this happens, how it's going to impact us? How can we afford Bank of America to go bankrupt or not? Right? By the way, there's a great movie about exactly that, where the president, it wasn't. It was like chairman of Federal Reserve, I believe. He got together like all those main bankers, including Warren Buffett, and he put them into the room, and he said, like, nobody is leaving this room until we come up with some kind of possible, feasible solution. What we're going to do with Lehman Brothers, right? The movie is called Too Big to Fail, right? So it's like more like a kind of documentary slash movie. Very interesting movie, by the way, right? So basically, stress testing is done in those difficult situations to understand what are the possible scenarios. Is the entire economy about to collapse or not? Okay, and that's what we're going to do in this particular case. We're going to do some stress testing for one big bank. Okay, this bank is big because those numbers that you see here, you see thousands, right? But the units here are millions. So 50,000 actually means 50 billions. Okay, so that's how much cash this bank needs in the beginning of the year. Again, looks like a huge amount, but if you look at Bank of America, who has trillions under management, right? So this bank is probably much smaller than Bank of America, right? So that's the background. Now let me talk about some concepts, some specific financial concepts that you read in that background section. Okay, and we touched on those concepts before when we had the tutorial C demonstration. If you took accounting, you know that there are three fundamental documents in finance or accounting/finance, right? Three main reporting documents, three main documents that publicly listed companies such as Bank of America generate. Okay, number one document. Number one. I'm just mentioning it first. It doesn't mean it's the most important document. All three are important. Number one document is balance sheet. Okay, what is a balance sheet, by the way? If you took an accounting course, you should know that. So, what does balance sheet show you about a company? Go ahead.
It shows I guess how their assets equal or like how they, I guess where they spend their money and how it's like.
Well, it's not about that. It's not about spending money. It is about assets.
Well,
it's about ownership, right?
I guess not like the physical spending part, but like sort of what all they own and then where those have gone, I guess.
Okay. It's not earning. If you're talking about earnings, it's income statement, right?
Yeah.
Now, balance sheet has a very specific definition. It's a snapshot of a company's assets and liabilities, right? Assets means something that a company owns, right? Liability means what?
They owe.
Yeah, what they owe, right? So as an individual, let's say you own certain things. Let's say you own a car, right? Because you drive a car. Let's say you own a house, okay? You own some cash. You have a bank account, with some cash in it. So those are your assets, right? But also, unfortunately, a typical person owns, in addition to owning, he or she owes something to the bank, right? A lot of people are buying things on credit. Like they own a big, nice truck, but they don't have money for it, so they took out, like, I don't know, a 5-year loan to pay back, right? So you also owe, let's say you own a truck, but you also owe money for that truck to the bank, right? So those are your liabilities. Now, if you subtract liabilities from your assets, you get what? So what kind of value will you get if you subtract what you owe from what you own?
Net worth.
Yeah, you'll get your net worth at the individual level, meaning like your true wealth, right? Because look, if you own 100,000 worth of goods, let's say that includes your car and your house, and you also owe, so you have debt amounting to $100,000, then your net wealth is zero. You don't have any money, because whatever you own, you also like financed it, right? However, if you paid some of that loan, let's say you owe only $50,000, then 100,000 minus 50 is 50,000, right? So that's your net worth. Now, on a balance sheet right here, they call it equity. Sometimes they call it like shareholders' equity. Equity means exactly the same thing, like net worth of a company, because they own something like assets. They owe certain things, meaning they owe money to banks, to creditors, right? So equity means what is actually owned in that company by shareholders, right? Of course, if equity goes down, a lot of creditors, they get suspicious, right? They call it leverage, or extreme leverage. They feel like you're borrowing too much, way beyond what you own, right? And that becomes a dangerous situation when you're borrowing too much and you cannot repay it, right? So that's the essence of balance sheet right here. So this financial model, I have it right here, includes a balance sheet. No,
Car being upside down. Being upside down.
what is being upside down?
Paying your loan is more than what your car is worth.
Yeah, it's like negative equity, and they call it like going, I forgot, like being in the negative, so like going below the waterline, like when your net worth is actually negative, right? So we don't have like an explicit balance sheet, but that's the idea. There are certain assets that you need to have, and you need to have certain equity, because otherwise nobody will give you loans, right? If your net worth is zero, right? If you have too much leverage, right? Now, so that's the first important document. The second important document in accounting is what? So number one is balance sheet. Number two is what? Income statement, right? Now, income statement is what you were talking about. It's basically your earnings, right? The money that's coming in, this is your revenue, your income, right? The money that is going out, which is your expense, and if you subtract your costs or your expenses from your revenues, you get what? That's your profit, right? Or net income, right? So basically, this is how any business works. They sell something or they offer some services. They charge you for those services. Then they subtract their costs from that figure of sales or service revenues, and they get their profit, right? So net income statement shows profitability for 1 year, right? It doesn't show assets, it doesn't show liabilities, it shows profits, basically, right? And then there is a third document. It's not discussed here, but it's present implicitly in your model. I think in a lot of accounting courses they would treat it like as a third. It's like a least important documents. But according to a lot of people, including one of my friends who was a CFO for a number of years, he said cash flows is he would say even more important than income statement and balance sheet. Right? Now, a cash flow document basically does exactly what the name says. It outlines your cash flows, cash that is coming in and cash that is coming out. Right? Income statement is not the same, although it has a lot of relationship to cash flows, is not the same as a cash flow statement, right? Because as you probably know, accountants, they keep records on a non-cash basis, right? On a non-cash basis. For example, let me give you an example of a non-cash transaction. Let's say let's say you sell tractors, I come to you to buy a tractor. But I buy this tractor on a loan. For example, let's say You give me this tractor, and I promise to pay you back for this tractor within 5 years, right? With 5 equal installments over the next 5 years. And the first installment, let's say, is due at the end of the first year. Okay? So you see what happened. You sold me the tractor, right? You sold it because now I'm using it. But you didn't get any cash for this tractor. Okay? So accountants would say, although you didn't get any cash, you still need to record that transaction as a revenue, right? Because you sold it to this person. Okay? So you see, it's a non-cash transaction. So what I'm saying, accounting is not done based on cash. It's done based on those definitions of what is considered to be revenue and expense. Okay? So cash is not the same as, income statements are not constructed based on cash inflow and cash outflow, right? So nevertheless, you need to keep track of cash, right? You need to keep track of cash. Because what's going to happen if you're short of cash? Let's say, your net income seems to be positive, in other words, it looks like that on paper, based on those accounting definitions, you are making money. However, you don't have enough cash to repay, let's say, your short-term loans. What's going to happen?
You're going to take more loans to pay those loans?
Well, I mean, yeah, that's a good point. I mean, you'll end up borrowing money, but the thing is, the thing about banks, they only like to lend money to people who don't need money, right? If you have a lot of assets, they will like you, they will give you like a lot of loans. But if you're short on money, if you don't have much cash, you don't have much income, they're not likely to give you a loan, right? I mean, that's the basic principle that they use. If you don't have enough cash to repay your immediate short-term obligations, then you may be declared bankrupt, right? Because if you don't have enough cash, I mean, you cannot meet your immediate payments. You'll miss your payments, let's say, on a bank loan, and you'll be declared bankrupt, right? So that's why you construct cash flow statements, because you need to understand, in addition to those accounting definitions of profit and loss, you need to understand how much cash you have, where the cash is going, and so forth, right? So you have that element of a cash flow statement as well. And again, the reason some people believe that cash flow statement is the most important statement, because it's something that is the most immediate indicator whether you're going to go bankrupt or not. Because I think the specific definition of bankruptcy means you cannot meet your loan obligations, right? That's bankruptcy, right? You owe a payment this month, you cannot do it, then after a while you'll be declared bankrupt, right? Although you may say, well, yeah, but I own like 2 houses or 2 farms and all those things. Okay, you own those assets, it's in your balance sheet, but you don't have cash. You don't have cash to meet your short-term obligations. That's why you go bankrupt, okay? And that's when they will come in and they will sell your house, right, to repay those obligations on a cash basis. Okay, so it's important to understand those concepts to understand this DSS model. Okay. All right, so let's do this now. We're going to talk about constant section. Just spend some time reading. Let's say about 2 sections. Constant section. It's on page 137, and also input section. It's on page 138, and also read summary of key results section, the first 3 sections. So read the information about constant section, input section, and summary of key results section, and then we'll talk briefly about it, and then we'll go into calculations. Okay. So let's talk about those first 3 sections of our stress test model. Okay, the first section that you have is called constants. Okay, and by the way, here we're assuming that we're at the end of 2015. So we just finished year 2015. So we're interested in projections for 2016, 17, and 18. Okay, so the first section is called constants. Now, constants means things that don't change, right? That's how they use this term in mathematics. So there are certain parameters that we assume will be sort of stable. Okay, so they're not dependent on our major factors that we're interested in here. Okay, now of course, some of those things are volatile, meaning they will be dependent on those parameters. However, you see, your DSS model cannot be infinitely complex. Okay? You need to make some simplifying assumptions. Otherwise, you'll have too many formulas, too much complexity, and you will never be able to fully understand what's happening in your model. Okay? So one thing that is assumed is that your tax rate will remain constant for the next 3 years. It will be 10%. Okay? The other thing that you assume is that your bank needs at least 50 billion. By the way, I'm not going to be saying like billions, I'll be saying like thousands, just to make it simple. Okay? But 50,000 here represents 50 billions, because the unit here is millions of dollars. Okay? So you're assuming that every year you need to have at least 50 billion or $50,000 to start your year. If you as a bank you have less than that in cash, it means you may not be solvent. Let's say if somebody comes in to withdraw money, or if you need to repay your loans, you won't be able to meet those obligations, right? Something like that. So you need to have at least $50,000 in cash. Then here you're making some assumptions about the deposits that you are likely to have over the next 3 years. Okay? Now those deposits, they represent how much money bring to you. How much money is brought to you by people. In other words, this is the money that people deposit into their savings or current accounts. Okay, so you're assuming what? That the deposits will grow over the next 3 years by a little bit. Again, it's a questionable assumption, because deposits may or may not grow depending on economic conditions. But that's what you're assuming to make things simple. Okay. Sorry. Excuse me. Can you please stop eating, because I just I hear this noise, somebody's chewing chips right in front of me. And then we have trading account assets. Now like a lot of banks nowadays, they engage in stock trading, meaning they invest into other companies, right? So they own stock and they're hoping to make money from it. By the way, it's something that is questionable, because a lot of people, especially like people like Warren Buffett, they would say that, look, you need to separate consumer banks from investment banks and speculators, because those guys sometimes they like risk, okay? And you don't want Bank of America to be like a risk taker, because that's where you are storing your savings money, right? So you don't want them to lose in this gambling game, basically, right? But nevertheless, banks do that. So basically, they're saying over the next 3 years, we're assuming that the value of our portfolio will grow in value, whatever that is. In other words, they may buy additional stock, or their stock may appreciate, okay? And then, so basically this is like stock that is owned by this specific bank, like other companies owned. Here we have long-term debt owed, meaning how much they will owe to long-term creditors. So again, it's assumed that it will grow by a little bit over the next 3 years. And here we have something called base equity for test purposes. Remember we talked about equity, right? And you probably know, like if you apply for a loan, your bank will ask you about what you own, meaning what kind of assets you have, right? And they will also ask you about what you owe. In other words, how many credit cards you have, how many outstanding loans you have at this present moment, right? Now, the reason they're asking you this, they want to get a sense of your net worth or equity, right? So basically, if they feel that you're already over-leveraged, meaning you owe a lot of money already, they will not give you their loan, right? Because it's too risky for them. So what they're trying to say here, they're saying, look, in order for a bank to be attractive to creditors, they need to have equity of at least $120 billion. Remember, like I asked you, so what's going to happen if they run out of cash? And somebody, I think it was Austin, right? Austin said, well, they will borrow more money. Yes, you can borrow more money if you are in good financial standing, meaning if you have some equity, right? So what they're saying to be viable, to be able to borrow money in the short run, to meet short-term cash obligations, they need to have equity of at least $120,000, okay? So this is what is meant by those constant sections. Okay, now inputs. Those are the main parameters that you're going to change to see whether your bank will withstand a particular stress. The first input is market volatility. Okay. Now, by market volatility here we mean changes in the stock market. Okay. Like for example, right now, stock market is kind of growing relatively stably. Right. There's a stability in growth. Okay. But sometimes markets are behaving crazy. They go like up and down all the time. I'm talking about Dow Jones. Okay, let me show you exactly what I'm talking about. So you see, this is Dow Jones. Dow Jones over the last 10 years, right? So you see, like right now. Before that there was like there are some fluctuations all the time, right? But they're like minor fluctuations. So this is like a stable period, okay? Now here, this is when the financial crisis happened. Look, there were like severe fluctuations. Within 1 year, look, it went all the way here, then it went all the way up, right? So this is high volatility, meaning a lot of change in the stock market, okay? By the way, I'm predicting recession. I mean, it cannot grow. I mean, there are already signs of some decline. I think it will go down. I mean, we're standing in the onset of a recession, next recession, because it's been stably growing for too long, and that's just like a natural law of life that everything will decline eventually, right? So it's already like, you see, there's this volatility. I think it will go down maybe within 1 or 2 years, okay? So this is what we mean by market volatility. Now let me ask you this. Is it good to have market volatility or bad for a bank? Bad, why is that?
Because they don't know how much they have to pay people in stress test situations.
Yeah, so high volatility means high uncertainty, right? They don't know what's going to happen. For example, they don't know how much money they will get from their investment, right? Also, what happens is that when stock goes down, people start panicking, they start selling everything, right? There's a term called run on the bank. Have you heard about this? Like Enron, again, if you took accounting, you probably know about Enron. Like Enron's CEO, Jeff Skilling, he claimed that Enron went bankrupt because of run on the bank. Now, run on the bank, it means like sometimes people, it happened in the old days all the time. Maybe not as much now. People start spreading rumors that a particular bank is about to go bankrupt. I mean, and this may or may not be true. Okay, because of those rumors, some people go to this bank to withdraw all of their money. They don't want to have any deposits with that bank, right? Because other people see that there's a line near that bank withdrawing money, they start saying, oh, I have my money in this bank as well. Maybe I should go withdraw money as well, right? So it creates this panic. It's called run on the bank, right? It creates this panic where everybody's withdrawing money, and the bank cannot meet those obligations, meaning they cannot give everybody's back money. Because you know that when you bring money to a bank invests it somewhere. They don't have it just in their repositories, right? So that causes bank to go bankrupt. Again, when there's a lot of volatility, people start panicking, and that's harmful for banks, right? So volatility is not good for a bank. Now, volatility is good for trading companies like E-Trade, like all those investment bankers, because they get their commission no matter what. Regardless of whether you're short selling or whether you're making profit, they get their commission on every sale. Okay? So the only companies that benefit from volatility are trading houses. Okay? And then we have economic outlook. We have 3 possibilities. Good means the economy is growing. Okay? Okay means it's stable, it's not growing but not declining, and poor means it's declining, right? So we have 3 economic scenarios. I mean, obviously, which economic scenario is the best one for this bank? Good economy, right? Because that's when people bring their money. That's when they feel it's safe to give out a lot of loans. That's when consumers feel confident that they can repay a particular loan, right? That's when they apply for loans. So good economy means good business for a bank. Okay. Okay, and summary of key results. By the way, those numbers come from elsewhere, and we'll talk about those calculations in a minute. But basically, here we have some of the most important financial indicators. Look, number 1, net income after taxes. This is how much money you're making in 2016. That's your profit as a bank. Okay, and then you also have the following indicator: end of the year cash on hand, meaning how much cash you have in your account at the end of the year. Now, you see, like, profit is not the same as cash, right? I mean, cash reserves is something that is different, okay? Of course, being profitable contributes to your cash reserves, right? Because that's where you get cash, from making profit, okay? And then you have end of the year short-term debt owed. By the way, right now, it's like a dash. I don't know why they're doing this way. I think it makes things a bit confusing. I would reformat those numbers to put zeros there, so it's clear it's a 0. So they have this custom formatting. I'll just put currency. Or not just number, okay? Because when you see 0, it kind of makes a bit more sense than a dash, okay? So basically, it means at the end of the year, this bank owes 0 in short-term loans, okay? Now, this situation is good, meaning, look, they have $300 billion in cash. They don't owe anything this year. I mean, they owe like those long-term debts, but they don't have anything for immediate repayment. So is it a good situation for a bank or a bad situation? It is good, right? Because they don't owe anything, they have enough cash. Therefore, it's pass, meaning you pass this stress test. This bank will pass this scenario, okay? However, look at the following scenario. Let's say there's high volatility, and then the economy is poor for the next 3 years, okay? If that's the case, look what's going to happen in 2017. In 2017, there will be no net income. So in parentheses means they're losing, there's a loss of $152 billion. Okay? Also, they only have $50 billion cash on hand at the end of the year. And they need to repay this year $118 billion in short-term loans. Now, in that case, they will fail that test because, look, they don't have enough cash to repay their short-term obligations. And that's a classic bankruptcy case. If you cannot pay, you need to declare bankruptcy, right? Something needs to be done to repay those short-term obligations. So that's how companies go bankrupt. They don't have cash to meet their immediate borrowing obligation. Immediate loan obligations, or immediate loan repayment obligations, okay? So you see it's going to fail it. Here it means like the bank is going bankrupt in this year. It will sort of hold its grounds here to be okay, kind of surviving, but here, in this year, it will fail, okay? So those are the key indicators. Which is kind of interesting, right? I mean, when we think about like business, we think about profit, right? It's not lack of profit that sends companies bankrupt. It's lack of cash, right? Inability to meet their obligations to repay their loans that sends them into bankruptcy. Not necessarily losses, because some companies, they can lose money for a number of years, like Amazon. I mean, I believe Amazon, they were losing money for the first 10 years of operations, but still they were solvent. In other words, they had enough cash from investors to meet their obligations, right? So that's why they were losing money for 10 years without going bankrupt, okay? So let's put it back. So we have normal, and then we have good, good, and good, okay? Now, how do you come up with those key indicators? Now, that brings us to our calculation section, okay? So I'll pause it here. In this section, we're doing basic calculations to kind of figure out parameters for the most important section of our model, which is income statement and cash flow statement. And this is something that we're going to probably do like in the second part of this tutorial, like on Thursday, okay? So for now, we just need to do those basic calculations. One idea here is that your calculations for a particular year are always based on the numbers from the previous year, right? It's called like extrapolation, right? So you're kind of extrapolating what you had for the previous year, and you're using this as a basis for making predictions or extrapolations for year after that, okay? So that's the idea. Like you're always basing your calculations for a particular year, let's say 2016, on numbers from the previous year, which is 2015, okay? And right now, I told you, you assume that we are kind of standing at the end of the year 2015, okay? So look. The first thing that you need to calculate for year 2016, and again, the same procedure will be repeated for 2017 and 2018, is consumer loans, okay? Now, consumer loans represent what, by the way? They represent money that you did what with that money?
Borrowed.
Who borrowed?
Their client, bank customers borrowed.
Okay, consumers, meaning the amount of loans, the total amount of loans that consumers, meaning bank customers, took out or have outstanding, right? Have outstanding for year 2016 is this amount, okay? Now, how do you calculate this amount? By the way, now we're getting into nested if formulas, okay? And that's why I asked you to watch that basic tutorial about Excel. I think all of you know if statements in Excel, and probably most of you know nested if statements, okay? So I'm not going to spend like too much time explaining theory. I'm just going to show you how it works right here. So look. So what they're saying if C13 is G, meaning the economic outlook is good, then consumer loans will grow by how many percent? 7% right here, okay? So that's how if works. Condition, output if true, right? You multiply it by 1.7, meaning you increase it by 7%. And then condition if false. And that's where you put your second if, nested if, right? So if that's not the case, if it's not G, then if it's O, and O means economy is doing okay, right here, okay? Then consumer loans will grow by 2%, okay? Then if P, meaning economy, is poor, then consumer loans will actually decline by 4%, okay? Now, why do consumer loans are likely to decline during gloomy, bad economy? What would you say?
People don't want to borrow anything.
Yeah, people either don't want to borrow, let's say they don't feel confident in their ability to repay, or they want to borrow, but banks feel like they're not in a good financial state to borrow money, right? So that's why consumer loans tend to go down. And then, there's like an error catch or exception, right? I mean, you would assume that people will enter G, O, or P. If somebody enters something else, it will show error in this cell. Okay? So this is how nested if works. Now, corporate loans. Now, the difference here is that here we're talking about corporate customers, right? So lending money to businesses. So the same kind of nested if structure, but the numbers are different. If economy is good, it grows by 5%. If economy is okay, it grows by 1%. If economy is poor, it goes down by 2%. Okay? Those are consumer loans. Now, interest rate on consumer loans, again, calculated using information from this input section. They're saying if economy is poor, then the interest rate on consumer loans will be 10%. If it's not poor, meaning if it's okay or good, then the interest rate will be 14%. So basically they're saying they're charging high interest rate during good economic times. Okay? Which seems to be the case, right? Oh, I'm not sure. Actually, I'm not sure about this one. But that's the formula that they're using. During good economic times, they're charging a higher interest rate. Although I believe like it could be that at least in some countries, banks tend to charge high interest rate during gloomy times because they feel like there's more risk in giving out those loans. Interest rate on corporate loans. Again, if economy is poor, it's 7%. If it's okay or good, it's 8%. Interest rate on trading assets. Look, this is what happens. Those are your trading assets, and here there are numbers that are given to us. Once again, trading assets means stock, means ownership that this bank has in other companies. Now, it's the value of stock that they own as a bank. Okay, so interest rate of trading assets is 12% if volatility is high, right? If there's a lot of volatility in the market. It's 10%. If there's not a lot of volatility, it's 12%. So basically they're saying during high volatility, they tend to make less money, less interest on their stock investment. Okay. By the way, here we have high or normal volatility, only one cell, because it's assumed it's true for all 3 years. So we don't have like separate inputs for year 2017 and 2018. So if you put N here, you're assuming that it will be normal for the next 3 years, meaning 16, 17, and 18. Okay. Okay, so by the way, to me, like those numbers, they don't look reasonable because, look, I'm a bit surprised that the profit that they're making on consumer loans is actually higher than the profit they're making on stock. I mean, it probably should be lower, right? Because stock is a high-risk investment. But again, it depends. Maybe I'm misinterpreting or miscalculating the risk on consumer loans as well.
Maybe it's taking that risk into account in terms of what they expect to pull from.
Yeah, that's what I'm saying. I think if you're talking about mortgages, right, then again, relatively low risk. Although like banks, they don't like people defaulting on mortgages as well because they don't want to get into real estate business, right? But I guess maybe it's correct. Maybe indeed consumer loans are much riskier than investment in the stock market. That's why they command higher interest rate. Interest rate paid on deposits. During good economic times, if this cell equals G, then they are paying to consumers 1.5 interest rate. To me, like this whole banking like savings doesn't work because, I mean, look, if you're getting, during good economic times, you're getting 1.5%, it's barely covering inflation because inflation can be between 1 and 2%. Right? So what's the point of saving money and locking them into savings account then? However, if economy is doing okay, they're paying only 1%. And if the economy is gloomy, they're paying 0.5%. Okay? Now, I remember like during recession, Bank of America, because I had my account with them for many years, they were paying like ridiculous percentage. It's not like 0.5%. It was like 0.2%, meaning a fraction of a percent. That's how much they were paying per year on interest rate on a savings account. Interest rate paid on short-term debt. Again, during good economic times, the bank is paying 1.5%. During okay times, they're paying less interest on their loans, on their short-term loans. Okay, so during okay times, they're paying 1%, and during gloomy times, gloomy economic times, they're paying 0.5%. Interest rate paid on long-term debt. So they have short-term debt and long-term debt. Debt that will mature like in the long run. So again, if it's a good economic times, they're paying 4%. if it's okay, economy is doing okay, they're paying 3.5%. If its economy is kind of going down, if it's poor economy, they pay 3%. Now, this doesn't make sense to me. What I don't understand here, in their assumption, I would challenge this model by saying that I don't understand why they're paying higher percentage on long-term debt versus short-term debt. To me, it doesn't make sense. Because short-term debt, I think, should have higher interest rate, okay, than long-term debt. But nevertheless, that's the kind of assumptions they have here. And then trading account expense ratio. Now, this is how it works. Let me talk about trading account first. You see, you own stocks as a bank. Okay, so this is the value of your stock. Now, if you as a bank, if you engage in those trading activities, you need to have your own, basically, trading department. You need to have those stock brokers working for you. Okay, they're the ones who will be buying and selling stock on your behalf. Now, this is not free. I mean, it's overhead. I mean, whenever you're buying or selling stock, you need to pay salaries to those people who manage your portfolio. Okay, so. And that's why, like some people say, look, if you're a bank, then stop trading. I mean, stop, paying those brokerage fees. Just deal with loans, right? So this is what will happen. If there's high volatility in the market, meaning the market is unpredictable, and the economy is poor, the expense ratio will reach 1.1. Okay, it basically means whatever revenue that you make from stock, right, will not be enough to cover your expenses, your trading expense. And also, it will be 110%. And also, you'll be losing money, which makes sense to me. Economy is poor, meaning the value of the stock is not increasing, it's decreasing. And there is a lot of volatility. When there is a lot of volatility, companies tend to buy and sell all the time because they're trying to manage their risk based on the current market information. So there's a lot of trading activities, and that's when they pay a lot of fees to brokers, high salaries to brokers. And that's why Warren Buffett says, don't do day trading, because you will, brokerage, even if you're okay, when it comes to predicting the movement of shares, you'll pay a lot of brokerage fees if you keep buying and selling every day. So what Warren Buffett suggests, he says, if you're not a professional investor, or even if you are a professional investor, invest for the long run. Buy stock at a low price and then just ignore the market. Don't react to it. Because if you keep trading, responding to those ups and downs, you will lose, at the minimum, you will lose money on brokerage fees. Okay? So that's why it's 110%. However, if we have combined end condition, if volatility is normal, meaning that you don't have too much fluctuation in stock, and the economy is poor, the expense ratio will be 90%, meaning you'll make some money on those trading activities. So the salaries, the overhead will be 90% of your stock revenues. And everything else, meaning it's not volatile, it's N, and the economy is doing okay or poor, you'll have a 60% expense ratio, meaning you'll have like a 40% profit margin on those activities, investment activities. Okay? So this is how it's calculated. Now, loan loss percentage, what it means you will lose a certain a certain proportion of your loans. And you lose it because of what? Why do you lose like a certain proportion of your loans?
Lack of payment or completion of loan.
No, it's not like loss, meaning it's not complete. Because you see, like in accounting, if you have your loan repaid, it's not loss. It means you transfer accounts receivable into cash. So it's not like any kind of loss. It's just like reshuffling of assets, right?
So you're talking about defaulting?
Yeah, it's defaulting. Some people simply don't pay money back, right? And nowadays I think bankruptcy law is very kind of, I mean, in my opinion, it's very humanistic. I think, I mean, what's going to happen? Let's say you take out a loan and you just don't pay it. That's it. So what's going to happen? And you don't have any assets.
You could end up in jail.
Well, it's the same in the United Arab Emirates. You basically, if you default on a big loan, you go to jail until you repay your loan. Although they're changing this legislation now. But in the United States, you don't go to jail, and after 10 years, they clear your credit history, right? It's like after 10 years. Okay? But again, it sounds simple, like you default on a loan, then you wait for 10 years. But again, look, you're sacrificing like 10 years of your financial life, basically, right? So it's not that good of a deal to kind of go through that path. But anyway, some people simply never pay back their loans, right? So what happens during poor economy and high volatility, they're saying 25% will default on their loans, meaning you lose 25% of your loan money. During poor economy and normal volatility, means there's no much risk happening, you lose 12%. And then the formula continues. During okay economy, you lose 5%. And during good economy, you'll lose 3%, regardless of whether the market is volatile or not. Okay? So that's how you calculate all those parameters. Again, you repeat the same thing for 2017 and 2018. Okay? We are running out of time, so when we come back in the next part of this tutorial, we'll talk about constructing income and cash flow statement based on those intermediary calculations. Okay? But for now, we're done with